Why did global shipping just stop? Economic collapse. Daily Voice News, economic collapse. http://dailyvoicenews.com. Shipping said to have ceased. Is the worldwide economy grinding to a halt? Last week, I received news from a contact who is friends with one of the biggest billionaire shipping families in the world. He told me they had no ships at sea right now, because operating them meant running at a loss. This weekend, reports are circulating saying much the same thing. The North Atlantic has little or no cargo ships traveling in its waters. Instead, they are anchored. Unmoving. Empty. You can see one such report here. According to it, commerce between Europe and North America has literally come to a halt. For the first time in known history, not one cargo ship is in transit in the North Atlantic between Europe and North America. All of them, hundreds, are either anchored offshore or in port. Nothing is moving. This has never happened before. It is a horrific economic sign, proof that commerce is literally stopped. We checked vesselfinder.com and it appears to show no ships in transit anywhere in the world. We aren't experts on shipping, however, so if you have a better site or source to track this apparent phenomenon, please let us know. If true, this would be catastrophic for world trade. Even if it's not true, shipping is still nearly dead in the water according to other indices. The Baltic Dry Index, an assessment of the price of moving major raw materials by sea, was already at record all-time lows a month ago. Factories aren't buying and retailers aren't stocking. The ratio of inventory to sales in the US is an indicator of this. The last time that ratio was this high was during the Great Recession in 2008. What recovery? The economy is taking on water at a rapid rate. The storm has been building for some time, actually. Not so long ago, there was a spate of reports that the world's automobile manufacturers were in trouble because cars were not selling and shipments were backing up around the world. Zero Hedge reported on it this way. In the past several years, one of the topics covered in detail on these pages has been the surge in such gimmicks designed to disguise lack of demand and end customer sales, used extensively by U.S. automotive manufacturers, better known as channel stuffing, of which General Motors is particularly guilty and whose inventory at dealer lots just hit a new record high. The world's economy seems in serious trouble. You can't print your way to prosperity. All you are doing is hollowing out your economy. Draining it. And sooner or later it's empty and you have to start over after a good deal of crisis and chaos. It's no coincidence that China is struggling desperately to contain a stock implosion. Reportedly, banks have been told they are forbidden to buy US dollars and numerous Chinese billionaires have gone missing. And the markets have just opened on Monday and are again deeply in the red. Here at the Dollar Vigilante we've specialized in explaining the reality of the global faux economy and why it's important that you not believe mainstream media lies. Every month we publish at least 2 editions of our TDV newsletter that, as our subscribers are aware, has predicted much of what is going on today. If you're not a subscriber, you ought to take advantage of our current low rates before they go up on February 1st. You can subscribe here. And set aside time for our one-day TDV Internationalization and Investment Summit that features some of the most insightful financial minds on the planet, including Ed Bugos, our extraordinary, in-house gold analyst and Austrian economist. I'll be there as well as a presenter and also to answer your questions about our upcoming Super Shmita trends and Jubilee year analysis. We've gained literally thousands of subscribers because of the accuracy of our forecasting and investment recommendations over the past year. Now is your chance, perhaps a final one, to get out in front of the chaos racing toward us by attending our one-day investment summit, followed by the 3-day Anarchapulco conference. I guarantee you'll come away refreshed, invigorated, and armed with insights to help you cope with what's going to be a very volatile and challenging 2016. In the meantime, keep your eye on this shipping story. If it is true and worldwide shipping is disastrously foundering, it'll only be a matter of days before grocery store shelves will reflect that with increasingly bare shelves. Are people upset now? Just wait. Interruptions in goods and services, most critically food, almost happened in 2008 during the Great Financial Crisis. For 3 days worldwide shipping was stranded due to shipping companies not knowing whether or not the receiver's bank credit was good. That crisis was staved off due to a massive amount of money printing. It was a temporary stay of execution, like bailing out the Titanic with coffee cups, however, and one that may reach much larger proportions in 2016. Sailors watch the weather to see if it is safe to set sail. Investors should be watching the economic climate with the same intensity. We are already sailing through very stormy waters. Global shipping veers into capital destruction. Overcapacity will be even greater than in 2009. I would be open to the possibility of reducing the Fed funds rate even further and go negative, explained Minneapolis Fed President Narayana Kocherlakota on Thursday. Some folks just don't get it. Here are the results of 7 years of global QE and zero interest rate policies. Global demand is going from sluggish to even more sluggish. Emerging market countries are leading the way, it is said, and China is sneezing. Brazil and Russia have caught pneumonia. Japan is feeling the hangover from Abenomics. Even if there is some growth in Europe, it's small. And the US, cleanest dirty shirt as it's now called, is getting bogged down. And here's what this is doing to the shipping industry, the thermometer of global economic growth. On one side, lack of demand. Due to the recent slowdown in world trade, shipping consultancy Drewry on Thursday slashed its forecast for container shipping growth, in terms of volume, to 2.2% for 2015 and lowered its estimates for future years. BIMCO, the largest international shipping association representing shipowners, issued its own, even gloomier report also on Thursday. On the U.S. West Coast, it's been slow all year, starting with the labor disputes that weren't resolved until mid-March. Since then, year-on-year growth in the second quarter was almost on par with 2014. But for the first half year alone, inbound loaded volumes dropped by 2% according to BIMCO data. On the Asia to Europe trades, volumes were down by 4.2% in the first half of the year as 7.4 million TEU, 20-foot container equivalent units, was transported. Northern European imports fell by 3.6%, while the East Med and Black Sea imports fell by 4.8%. Intra-Asia shipments remain a stronghold with ongoing positive growth around 4 to 5%, but the increased uncertainty surrounding the economic development in China adds doubt as to whether such a strong growth rate can be sustained for the full year. At the same time, as shipping volumes struggle, freight rates have collapsed, and revenues with them. On the other side, overcapacity. Drewry estimates that an additional 1.6 million TEU of new capacity is being added to the container shipping fleet this year, and not enough ships are being scrapped. Hence a fleet growth rate of 7.7%. As a result, Drewry's Global Supply/Demand Index, a measure of the relative balance of vessel capacity and cargo demand in the market where 100 equals equilibrium, has fallen to a reading of 91 in 2015, its lowest level since the recession-ravaged year of 2009. But in 2016, another 1.3 million TEU of new capacity will be delivered. Drewry projects that its Global Supply/Demand Index will fall to its lowest level on record over the next few years, indicating that the overhang of excess capacity will be even greater than that experienced in 2009. So freight rates have crashed globally. But graciously, the oil price crash led to lower bunker fuel prices, which has kept some, but not all shippers afloat. Shipping lines have responded half-heartedly with idling some of their ships, but so far without great success in raising rates. And these ships are heavily leveraged, so idling them and not earning revenues while having to service their debts isn't helping matters. So shipping loans are a doozy. Daily Voice News, Economic Collapse. http://dailyvoicenews.com. Germany is a hotbed for shipping loans, to the point where Andreas Dombaret, member of the executive board of the Bundesbank, highlighted them in February 2013 as one of the 4 risks to overall financial stability in Germany. He fingered 2 causes: plunging freight rates and overbuilding of ships of ever larger sizes, driven by cheaply available financial means, a direct reference to easy money policies. He waded into the bloodbath in Germany, shipping loan retail funds that blew up and were shuttered, banks whose shipping portfolios suffered heavy hits, an industry that was breaking down. The Bundesbank was looking at it from a broader perspective, he said, with an eye on the stability of the entire financial system. He knew what he was talking about. A month later, the largest ship financing bank in the world, HSH Nordbank, which had been bailed out in 2008, recollapsed and was re-bailed out by its two main owners, the German states of Hamburg and Schleswig-Holstein. The ECB, which now regulates the largest European banks and last year conducted the most intrusive stress tests in EU history, is putting pressure on HSH to finally clean up its bad loans, which still make up a stunning 23% of its total loan book, sources told Reuters in July. Even some Greek banks don't have this much putrefaction hidden in their basements. In the US, Citigroup sallied into shipping loans when it bought a significant part of Société Générale's shipping loan book for an undisclosed price in June 2012. Citi is looking to increase their shipping exposure in the market, and it is easier to acquire loans rather than originate them from scratch, the source told Reuters at the time. It would have an edge in dealing with the shipping loans because they're mostly in dollars. A year later, Citi converted about $500 million of loans to non-US shipping companies into complex structured securities in order to roll some of the risk off to other investors, for a price, a yield between 13% and 15%, these people told the Wall Street Journal. Not sure how the deal turned out and what happened to the remaining shipping loans on Citi's books, but since then. Here's what's been happening in bankruptcy court. September 29, 2015, shipping company Daiichi Chuo filed for bankruptcy protection in Tokyo after 4 years in a row of losses, listing about $1 billion in liabilities. February 2015, Copenship filed for bankruptcy in Copenhagen, Denmark, after losing its behind in the dry bulk market that has been struggling for a lot longer than the container market. February 2015, China's Winland Ocean Shipping Corp filed for Chapter 11 bankruptcy in the U.S. The combination of lower steel demand in China and the huge volume of new tonnage coming online is what is causing panic and making this the worst bulk market since the mid-1980s, explained at the time HSU Chichien, chairman of Hong Kong and Singapore-listed shipper Courage Marine. August 2014, Nautilus Holdings and subsidiaries filed for Chapter 11 bankruptcy in New York, listing $770 million in debts. April 2014, Genco Shipping and Trading, owned by New York shipping tycoon Peter Georgiopoulos, filed for Chapter 11 bankruptcy in New York, listing about $1.5 billion in liabilities. July 2013, Excel Maritime Carriers filed for bankruptcy. There were other shipping companies that destroyed investor capital in a similar manner, and more will join. The dry bulk fiasco started years ago, and the commodities rout has made it worse. Container shipping is just now getting put through the ringer, and the financial pain, as Drury put it, will last for years. This is what our dear soon-to-be Professor Kocher Lakota doesn't get, when as a result of monetary policies, the cost of capital has been close to nil for the right folks for long enough, and desperate investors are out there blindly chasing whatever yields they can get. There are consequences, malinvestments. And they beget overcapacity and oversupply, which beget the destruction of pricing power, which unleashes deflationary forces, which inflict heavy losses on companies in the sector, which finally seek refuge in bankruptcies, which finalize capital destruction. None of which beget a healthy economy. So there are some issues in this distorted world, demonstrated by scary chart of a staggering reversal. Read. China, Russia, Norway, Brazil, Taiwan dump U.S. treasuries. Daily Voice News, Economic Collapse. http://dailyvoicenews.com. Why did global shipping just stop economic collapse?